There is one person in America, one single human being who can walk into a room, say a few sentences, and move your stock up or down. No, I'm not talking about the guy that posts on Truth Social and X and wherever the hell he's posting these days. And they can move your stock and they don't even work at the company. They've probably never even used the app. And yet, what they decide matters more to the stock than almost anything the CEO does. That person is the chair of the Federal Reserve. And as of this month, there is a brand new one. His name is Kevin Warsh. And for SoFi, this changes everything. And today we're going to be looking at 3 areas for you to help you adjust your exposure. The first one is going to be why lower interest rates matter so much for SoFi, specifically more than almost any other stock. Who Kevin Warsh actually is and why Trump picked him and whether he really wants to cut rates, and exactly how this affects SoFi and which way, including the honest risks, all in this video for you today. June 16th is the date to circle. Let's get into it.
Welcome to the game, it's the Instant Stocks by Mikhail Kuhar.
But before we do, if you don't know who I am, my name is Mikhail and I create videos every single day, multiple videos every single day on YouTube, covering stocks that can 5, 10x and possibly even more. You can check out my other channel here where I'm diving into one specific stock every single day for you. And outside of that, I've been a partner at X10 Day Trade where we've built an AutoPilot system that allows our team of professional traders trade directly through your Interactive Brokers account. One of the things I absolutely love about this is I'm a big believer of the thesis that you should have your investments structured 80-20. 80% long-term deep conviction in companies that you truly believe in long-term, and the other 20% in more short-term trade options or in and out of the market, however you see fit. And one of the great things about what we do on the back end is that we never touch your money. It stays in your account the whole time. And our pro traders send signals through to your Interactive Brokers account to make the trades. I'll show you our recent results over the last 2 weeks. This is a summary in the first week of May. So you can see here over the week, we took 6 trades in total. Now, you might not see that as many trades, but we don't force trades. We're waiting for perfect setups every single time. And the end of the week, we had a 41% profit, which means you would have seen a 4% increase in your portfolio. With a portfolio size of 50K, that would have been 2K realized profit. One of the great things is it's liquid, right? If you're not in a trade, usually 95% of our trades are same day trades. You're in and out of the market within sometimes a few minutes, and you can have that realized profit in your account. And the following week here, we had pretty much a break-even week. So the reality in this kind of space is you're going to have some red weeks, you're going to have some break-even weeks, and you're going to have some green weeks. We recently came off a 7-month run where we generated 25% realized gains for all of our clients. We've got just over 500 members right now. So if you're looking to find out how our pro traders can trade directly for you, completely hands-off, there'll be a link below. Click on that or go to x10daytrade.com and I will take the call with you personally to better understand if this is possibly even a good fit for you. Without further ado, let's get stuck into today's video. So before we can talk about the new Fed chair, you have to understand why interest rates matter so much for this company, because rates matter for every stock a little bit, but for SoFi, they matter a lot. SoFi is not a software company selling app subscriptions. SoFi is a bank and a lender, and a lender's entire business model is quite literally made out of interest rates. Here's how a bank makes money, very much simplified. You might already know this, but it takes in your money, your deposits, your savings, and pays you a small amount of interest. Then it lends that money out to other people, personal loans, student loans, home loans, and the charges a bigger interest rate. The profit is the gap between these two numbers. What SoFi charges borrowers minus what it pays depositors. Bankers call that net interest margin. You can call it a spread. The spread is the heartbeat of a lending business. So we built out a bit of a graph to help you understand how this is directly beneficial to SoFi. If Fed rate gets cuts, borrowing starts to get cheaper. SoFi pays less on deposits, more loans, and fatter margins. And then the SoFi, the business, and the stock will benefit. That is the whole story in one line. Now look at these 3 boxes below we've highlighted. These are 3 separate channels through which a rate cut helps SoFi. The first one is cheaper deposits. SoFi pays interest on customer savings. When the Fed cuts, SoFi pays less on those deposits. Lower cuts of funding just equal more profit on every loan. The second part is more loan demand. So when rates fall, borrowing gets cheaper for everyone. Personal loans cost less, student loan refinancing makes sense again, and home loans become affordable. And then that leads to more people borrowing. SoFi makes more loans, and lending is SoFi's core revenue engine. The third part of this is just the risk sentiment. So when rates fall, safe bonds pay less. Investors go hunting for growth. Money flows back into fast-growing fintech stocks like SoFi. That lifts the valuation multiple, the price investors pay for each dollar of earnings. Boxes 1 and 2 make SoFi's earnings bigger. The third box makes investors pay more for those earnings. Very important distinction in there. And if earnings and a multiple go up at the same time, you get them multiplying together. And that is why rate cuts can be so explosive for SoFi. And if we flip all three of these channels, you get the headwind picture. High rates squeeze SoFi's deposit spread, cool loan demand, and keep the multiple compressed. That is a big part of why SoFi trades around $15 today, down nearly 40% year to date. A great company swimming against the rate tide. One more fact that makes this incredibly concrete is SoFi's own 2026 guidance. The company's official financial plan was reportedly built on the assumption the Fed would cut rates roughly 2 times this year. The company baked rate cuts into its own playbook. If the cuts come, the plan is on track. If the cuts don't come, the plan gets harder. That is how central this is. Now, SoFi is not a bystander to Fed policy. It is wired to it. Now, let's meet the big dog, Kevin Warsh, confirmed by the Senate on May 13th, 54 to 45 vote, the most decisive confirmation vote for a Fed chair in the entire history of the institution. He is now the 17th chair of the Federal Reserve. His term as chair began May 15th, when Jeremy Powell's chair term expired, and his first Federal Open Market Committee meeting, the first time he runs the rate setting committee, is June 16th and 17th. That is a date to circle. On June 16 and 17, we're going to see a new rate path forecast from the Fed. The left-hand side we can see here pushing Warsh towards cuts. We're going to compare that to blocking him from near-term cuts. Now, the first part being Trump appointed him specifically to deliver lower rates. Warsh has personally been on record favoring cuts. He believes AI productivity gains can ease inflation over time, a forward-looking argument that gives him room to cut even when today's inflation looks hot. Now, a Fed chair holds strong power to persuade the committee over time. Now, on the other side of this, April 26th, inflation rose at the fastest pace in 3 years, nearly 4% annual, double the 2% target. An oil price shock from the Iran war is fueling that inflation. Now, a divided committee, 4 of 12 voting members dissented at the April meeting, most divided since 1992. Markets currently price under 3% odds of any 2026 rate cut, and the chair has only 1 of 12 votes. He must build consensus. The direction is real. The timing is the complication. So who even is Kevin, and should you trust the he will cut story? He's 56 years old, from Stanford and Harvard educated, and here's what gives him real credibility. This is not his first time at the Fed. Back in 2006, he was appointed as Fed governor at just 35 years old, the youngest ever. He served through the 2008 financial crisis right alongside Chair Ben Bernanke as the Fed made emergency decisions to keep the banking system from collapsing. He left the Fed in 2011. Warsh is not a rookie. He's not a first-time player. It's not the first time he's been in this arena. He has been in that room doing genuine crisis before. Now, the honest part of all of this, the Warsh wants to cut story, it is real. There is validity to it. He was picked to cut, on record favoring cuts. His AI productivity argument gives him a forward-looking path to cut even while today's inflation looks hot. The direction of his intent genuinely points toward cuts. But the timing is the hard part. See, April 2026, US consumer prices rose at the fastest pace in 3 years, near 4% annual, double the Fed's 2% rate, driven by an oil price shock from the Iran war. You cannot cut rates while inflation is spiking. It would be like turning up the heat while your house is already on fire. And one of the key parts to this that a lot of people get wrong about the Fed chair is Warsh does not control rates by himself. He's not the big dog that comes in and just lays down the land and makes the rule. Rates are set by a committee, 12 voting members. Warsh has exactly 1 of those 12 votes. 4 of 12 members dissented at the April meeting. That essentially means they publicly just disagreed with what was going on. Some were pushing language that hints at hikes, not cuts. And Jeremy Powell, the man Warsh replaced as chair, is still on the Fed as a governor until 2028. Still in the room, still voting. So the honest bottom line is a chair who wants to cut is now in charge. The table is set, but the kitchen itself, lack of a better term, is on fire. And as of mid-May, right now, market prices under 3% odds of any cut at any remaining 2026 meeting. Now let's start to land this plane. We know why rates matter for SoFi. 3 stacking channels. We know Warsh wants to cut, but it's boxed in by inflation. So which way does this hit the stock? So if Warsh does deliver cuts, we can see on the left-hand side here, we're going to see an improvement on margins. SoFi pays less on deposits. The spread widens, more profit on every loan. Very basic business economics, right? The loan demand will increase. Cheaper borrowing pulls in more customers across personal, student, and home loans. SoFi's core revenue engine gets a full tank of juice. The third part of this is going to be the re-rating. Risk on money flows back to fintech growth stocks. The valuation multiple expands. The combined effect, bigger earnings and a bigger multiple, all multiplying together. Now, the right side of this, if rates stay high, that'll be a headwind. Tighter margins, high funding costs keep squeezing the spread SoFi earns on lending. Softer loan demand, expensive loans means fewer borrowers. Pressure on the core growth of the business. The multiple continues to stay low. The risk-off mood keeps fintech valuations compressed, and the re-rating has to wait. The guidance risk, SoFi's 2026 plan assumed cuts. A long delay makes that outlook harder to hit. Now, Kevin Warsh was handpicked to lower rates and is personally inclined to cut. That genuinely matters for SoFi still, because SoFi's whole business is wired to benefit when rates fall. Keep this in your diary. June 16, June 17th is the first meeting and the moment to watch. Do people still keep diaries these days? Maybe it's a bit more old school. Maybe some of you guys are pen and paper, but I don't think I've ever actively kept a diary that's helped me be more organized than my Google Calendar. But anyway, the other thing we need to look at, near-term cuts are not guaranteed. An oil-driven inflation spike and a divided Fed makes a June cut unlikely. Markets price under 3% odds of any 2026 cut. The realistic read is a chair who wants to cut is now in charge, but the cuts themselves depend on inflation cooling. This is a catalyst potential, not a sure thing. As always, not financial advice. Do your own research. As I say in most of my videos, look at everything as objective as you possibly can. The videos I'm watching, the articles you're reading, the analysis report, everything you're consuming, look at it objectively, because all this information that I'm bringing to you every single day, the whole intention is to help you position yourself and adjust yourself for the exposure. Because us at X10 wish there was more content like this going so deep and specific on stocks every single day to help you adjust positions. It's one of the reasons why here we were early on things like Tesla, Hood, AMD, and Palantir, because of unfiltered content from people bringing it every single day on platforms like YouTube and X and newsletters. It's helped us establish our positions over the years. So I hope we can do that for you as well. As always, if you're hanging out to the end, I appreciate you. Drop a comment below. Let me know you're here to the end. And as always, I'll see you in a video tomorrow.